Welcome to this video on dividend investing. Today, I'm going to walk you through what dividend investing is, how it works, and why it can be a great tool for investors who want to build up their wealth. Dividend investing is a strategy of earning income from owning stocks, in which investors receive regular payments, dividends, from the companies they own. It's a way to build wealth over time as dividends have historically grown faster than inflation, allowing investors to preserve their capital and generate income. Dividend investing has become increasingly popular in recent years due to its potential for consistent returns and low risk compared to more volatile strategies like day trading. Typically, dividend-paying companies will pay out a set amount each quarter or year, usually as a percentage of their overall profits. This means that if the company does well, so do you, you'll get larger dividends as profits grow. On the other hand, if the company experiences losses, your dividends may also decrease or remain stagnant. In addition to these quarterly or semi-annual payments, there are also special dividend payments that are made outside of the normal cycle as an extra reward for their investors. Dividend yields are calculated by taking the total amount of dividends paid over a certain period and dividing it by the total share price during that same time frame. This information is important because it can help investors understand how much they're earning from owning a particular stock. Generally speaking, higher dividend yields indicate that more money is being paid out relative to what's invested in the stock. The timing of dividend payments is also important because it can affect your overall return rate on investments in stocks paying dividends. Investors who own stocks during the payment period will receive their dividends right away. However, those who don't own the stock at that time won't receive those payments until they buy those shares at a later date, which means they could miss out on any potential increases in share value due to dividends paid during that period of time when they weren't invested in the stock. Overall, understanding how often companies pay dividends and what their dividend yields look like can be an invaluable tool for maximizing returns on investments with dividend-paying stocks. By researching different stocks thoroughly before investing, investors can make sure they take full advantage of receiving those regular payments from their investments and make sure they're getting the most bang for their buck. One effective way to maximize dividend income is to invest in stocks with a high dividend yield. Dividend yields are calculated by taking the total amount of dividends paid out over a certain period of time and dividing it by the total share price. Companies that have higher yields tend to give larger returns on investment because they are paying out more relative to their share price. However, it's important to remember that high yields may also be indicative of company trouble, so it's important to research the underlying company thoroughly before investing. Another strategy for maximizing dividend income is reinvesting those payments back into the same stock or other dividend-paying stocks. This is known as dollar-cost averaging, which basically means buying more shares when prices are low and fewer when prices are high. By reinvesting payments back into the same stock or other dividend-paying stocks, investors can increase their overall return rate on investments over time. In addition to these two strategies, investors should also consider diversifying their portfolio across different sectors and industries when investing in dividend stocks. This will help limit exposure to risk as different industries can experience fluctuations due to factors such as economic cycles and political changes. Furthermore, investing in multiple companies from a variety of industries provides better protection against downturns since even if one sector experiences losses, there may still be profits being made from others. Finally, investors should also look for companies that offer special dividends outside of their regular payment cycle as they can provide an extra boost in income without having to invest any additional capital. Special dividends may be offered during times where the company experienced higher than expected profit growth or announced an acquisition or new product launch. By following these strategies and researching companies thoroughly before investing, investors can increase their chances of generating steady income through dividend investing while reducing their exposure to risk and protecting their capital over time. Dividend income is generally subject to taxation, depending on the type of dividend payments received and the individual's financial situation. There are two main types of dividends: qualified dividends and non-qualified dividends. Qualified dividends are taxed at a lower rate than ordinary income, while non-qualified dividends are taxed as ordinary income. Qualified dividends are taxable at a maximum tax rate of 20% for individuals in the highest tax bracket, while those in lower brackets may be taxed as low as 0%. In order to qualify for this preferential tax treatment, The dividend must have been paid by a U.S. corporation or a foreign corporation that trades its stock publicly on an established U.S. stock exchange and must have been held for more than 60 days during the 121-day period beginning 60 days before the ex-dividend date. Non-qualified dividends, on the other hand, do not qualify for long-term capital gains tax rates and must be reported as ordinary income with taxes being due at each individual taxpayer's applicable marginal tax rate. In addition, most states also impose their own taxes on dividend payments, which could vary from state to state. In terms of retirement accounts such as 401ks and IRAs, any money withdrawn from these accounts is typically subject to regular income taxes and should be reported when filing taxes accordingly. Furthermore, those younger than 59.5 years old may be liable to pay an additional 10% early withdrawal penalty if they were to withdraw money within 5 years of opening a retirement account unless certain exceptions apply. When it comes to dividend investing strategies such as dollar-cost averaging or investing in stocks with higher yields, it is important to bear in mind that while these strategies can potentially increase returns over time, they can also increase exposure to risk as well and should be discussed with a financial advisor or accountant prior to implementation in order to minimize potential losses and maximize potential gains from investments in stocks paying out dividends. Dividend investing can be used by any investor looking for steady returns with less volatility than stock market speculators typically experience. It can also be an attractive option for retirees who want regular payments to supplement their retirement income without having to withdraw large sums of money at once from their portfolio. Finally, since reinvesting dividends often results in compounding gains over time, dividend investors may benefit from compounding growth even when markets are volatile or down.